Court is now resumed. You may be seated.
Good afternoon, Mr. Hutchings. We are going to start a new topic at slide 210 entitled Contrasting Critiques with Conservatism in My Analysis. That's your slide cover. And I guess that takes us to slide 211. So what does this graph tell us? What are you trying to tell us?
Sure. So in slide 211, I'm starting to turn to some of those non-key areas of disagreement. I think it's as I labeled them earlier, areas of disagreement where the quantitative impact is relatively small. You know, I think I had that chart we talked about just before lunch of, and I'm on slide 211, where I showed that, you know, forestry and transport were the two kind of big ticket items. We had that chart. But I wanted to address some of the others that I know Professors Beaudoin and Smart discuss in their rebuttal report and that I gather have been discussed in this case. So if we're on slide, okay.
Yeah, we're on slide 211. We're just having some technical difficulties on the monitors.
No worries. So the starting row there is my 1 I've added a couple of decimal points so we can see it's 1,043,900,000. And there are a few categories that I then adjust for to show the impact on the results. So the first is insect control expenses. Professors Beaudoin and Smart include this. I don't, and by included, I mean they deduct the expenses. I show here to include all of those expenses has an impact on my results of $530,000. That's the middle column impact. In parentheses means it's a negative. And as a percent of.
So it's impact on the net.
That's correct. Impact on the net. And that is an impact of 0.05% on the total. The next critique is mining. Sorry. So line 3 is mining rehabilitation and forfeiture expenses. They include those. If I were to include those expenses and deduct them, the value would reduce by a further $60,000. That's the 0.06 million in the second column.
I want to just stop you for a moment. We're going through impacts of their critiques of your treatment. Did you address these in your report?
Yes, in my reply report. I think we continue to have this disagreement. I'm just trying to put some numbers on it so we're not simply.
So we're not going to spend time today or on Tuesday going over these small little items that you've indicated they're in your report. You disagree with them, but the point of what you're telling us is to just identify the areas that there's some small disagreement.
Yes, I think this is the companion to the one before, the chart before that shows forestry and transport account for 95%, I think. These account for 6% of 1%, as shown in the bottom right. So I'm just trying to include these for completeness. So no one's just taking my word for it, if you will. I want to show the math on why I said these were smaller areas of disagreement.
Okay.
The next item, line 4, is land agent salaries. So you might recall I talked about how 1850 to 97, some lands were granted free, some were sold for revenue. I make an adjustment to exclude a portion of salaries based on the acreage of lands sold versus those granted free. Professors Beaudoin and Smart think it should all be included. So that's what this is about. And that has an impact of about $10,000 nominal. There's then, and I think this showed up in our 1915 to 20 analysis yesterday, line 5, all of this still on slide 211.
But it's a zero impact, so.
Yeah, exactly. Is squatters' rights, which has an impact, but it's even less than $10,000. And then the final one is the forest reserve expenses. We talked a little bit about that yesterday as well. But in total, over all those years, the impact on our ST is $70,000. So all told, this is line 7. This is a $670,000 impact, or about 0.06% or 6% of 1%
Of nominal,
of nominal NCRRs.
of the 1.044 billion.
That's correct.
Okay.
So some of the areas of disagreement that are more minor quantitatively. On slide 212, I just want to contrast that with, one of the expenses I include, but Professors Beaudoin and Smart don't, is an expense related to hydroelectricity. I think this has come up before about the 2%. And if I were to adopt their approach and not charge any expenses for hydroelectricity, the impact would be an increase in my estimates of 8.49 million, which is substantially different, substantially higher than the impact of the criticisms from the prior slide. I'm not suggesting that's the right approach. I still think it's appropriate to deduct an expense for hydroelectricity. I also don't think it's appropriate to deduct the expenses on the prior slide for the reasons stated in my report. I don't think either of those are quantitatively significant. As the court was asking before lunch, what's the question on the exam? I'm just doing all of this to highlight. There's a lot of other little things. I know I spent some time talking about it, but a lot of that was to explain why I feel so comfortable saying it's forestry and transportation.
So that takes us to slide 213 and 214, and you want to talk about the accounting for the time value of money?
Yes, so Professor Stiglitz talked about last week how economists think about converting dollars in the past to dollars today. And I've done everything in nominal terms to date, which means $1 in 1900 equals $1 in 1950 equals $1 today, even though it's universally accepted in economics that the dollar in 1950 was worth more than the dollar today, and the dollar in 1900 was worth even more still because of this concept of the time value of money. And this is just a quote from my textbook. I think both myself and Professors Beaudoin and Smart cite to this text. It's a pretty common practical text, Principles of Corporate Finance by Richard Brealey and Stu Myers, and then Frank Allen. And it just says here, a dollar today is worth more than a dollar tomorrow, because the dollar today can be invested to start earning interest immediately. And an equivalent statement is a dollar today, a dollar yesterday is worth more than a dollar today, because the dollar yesterday could have been invested. You follow that back in time for 170 years, and you get the same idea. So the interest rate, as they say, it could have been invested. So the interest rate on that investment that we want to think about is the opportunity cost, which is fancy economist language for the cost of the next best opportunity, or what did you give up? So if you had had that dollar, what would you have done with it? And that depends on the investment opportunities that will be available to you. What one of us might do with a dollar might be different than what a company does with a dollar, might be different than what the Crown does with a dollar. And one has to be alive to that, if you will, and evaluate the investment opportunities. And I won't rehash it because I think Professor Stiglitz went through in some detail why the risk concerns of a large investor or a social investor or an investor with a long time horizon is different than what other people might consider. What you might consider as an individual is different than as a group. And it doesn't take many people to diversify risk in a significant way. This is why you can have insurance, for example, or social benefits. Any one person may not be able to handle a sickness or a car accident or loss of a job, something like that. But given the probability distributions around that, once you put together enough people, you can quickly say, well, in this group of people, we can expect 2 car accidents, 1 divorce, 3 people to have an injury, so on and so forth. And then you can plan for that with some more certainty. Whereas any individual might say, well, yeah, there's a small chance it's going to happen, but if it does happen, I need my rainy day fund. And that rainy day fund, you need it when you need it. But for the big group, you diversify that. And that's why the business risk is different. But so that's a rehash of why a portfolio that includes equity is appropriate for a social group, particularly one that doesn't have finite life. That's the big thing that economists are worried about. Because you need that money in retirement. And when you start approaching retirement, your tolerance to take on risk shifts a lot. So on slide 215, I talk about the mechanics of calculating that 60/40 portfolio. I think this was a question posed to Professor Stiglitz, and I will get to it. And so I finally got to it now on slide 215. So the standard approach to determining the expected return on equity is that it's a risk-free rate plus a risk premium. And we calculate that from historical data, because we have data for long periods of time. And I should say, I didn't calculate the risk premium in this case. I took the usual approach of going to the literature, which is what most people do. There are, in fact, so-called yearbooks now where financial data services companies publish for different industries these things. So why does that work? Well, the idea in economics is that there's always that risk-free benchmark rate, and government bonds are a fair proxy for that, and the usual one. And then you add to that, well, if you're bearing risk in the market, you need to be compensated for that. Otherwise, why would you bear risk? You always have that risk-free option. And the ability to bear risk can be different, but the compensation for bearing that risk is the same. So from 1926 to today, I use an equity risk premium of 4.5%. As I said, I just took that from the literature. There was a paper in 2019 from Professor Booth that looks at the equity returns in Canada specifically over this period. Similar papers exist for other countries, very standard method.
I'm going to stop you there. That's Professor Booth. That's the same from Booth and Kirshner, who are Ontario's, Mr. Booth from Ontario's witness, Canada's witness, excuse me.
Yes, it's the same Professor Booth from Rotman.
Okay, and I just because it jumps out at me, you say an amount of 4.5%, but you've told us earlier that your combined 60/40 is 7.2% on average.
Sure.
So
So
you can explain the difference there?
yeah, the 4.5% is what's added to the risk-free rate in each year. So we'll get to, I think in a slide or two, I have the picture from the table. That translates to a nominal return on equities of about 10.9%. So the 4.5 plus the risk-free rate on average is 10.9% in this period. And that's how I get to 7.2, because it's some of that 10.9, some of the 5% in a blend, and I get to 7.2.
Okay,
Is that helpful?
yes, thank you.
So before 19...
Especially if you're going to get to it.
Easy thing to promise, I just have to deliver. From 1850 to 1925, there's not a similar paper on Canadian equities, but there's a number of studies of US equities. A particular paper I use goes back to, I think, 1801, and was addressing other historical curiosities of equity returns. But I can use the difference in risk premiums they observe from 1850 to 1925 versus after 1925. And so I adjust Professor Booth's estimated risk premium down to 1/2 or 2.25%.
Sorry, can you explain what, how would you characterize reducing it 2.25? Why would you do that?
Well, that 4.5% was based on data from 1926 to present, where there's, I guess, typically agreed to be very well functioning equity markets in Canada. For the prior period, I have data in the US from 1801 through to today. They've kind of divvied it up into time periods, and looking at the relative difference in the equity risk premium. I see in the US, the risk premium increased over time. And so when I go back in time, I want to decrease it to make sure I'm not overcompensating. And then I arrive at 2.25%.
Okay,
For the risk-free security, I generally use the return to long-term Canada bonds, which is a fairly standard approach. And these are the same long-term Canada bonds that Professors Beaudoin and Smart use. There are a few periods of time where I use return on Ontario bonds because there was a text I used, an academic study of the history of interest rates. I mean, they go way back, like 14, 15, 1600s in Europe. But they had a discussion about the relative risk of Ontario and Canada bonds in the latter part of the 19th century and suggested that the Ontario bond market was more liquid. So I took those results, but that doesn't lead to a large difference in our rates.
so which risk-free return gives an investor better returns? Is it the Ontario bonds or Canada bonds?
In general, the Ontario bonds, but I only use it for a small period of time.
And are you able to give some idea what you say the difference is small? Like, how would you, can you characterize or give us a sense of the difference that you're using Ontario versus the long-term Canada bond rates makes to the overall picture?
Oh, to the overall picture,
Yeah,
very small. For the years where I do it, it would be measured in basis points, not percentage points. Basis points is hundredths of a percentage point. So 1 percentage point is 100 basis points. So it's less than 1% difference, I believe, in those years. And overall, that would be a very small difference. I don't have the numbers calculated here.
okay.
Yeah, and so then the final point is just a mechanical one, because investors and most financial data is available based on a year, where a year means January to December, but the government year changes from time to time, October, March, December. There has to be a few adjustments in those years, so the interest is only compounded for the appropriate number of months, but that's a very small point.
Right, I'm not going to take you through the details in your report about how you implemented the 60-40 equity to debt approach, but it's there for people to read, I take it.
Yes, it's there, and in the work papers, there'd be the rates in every year and the adjustments. I'm happy to discuss it, but I think this is a high-level summary.
Yeah, no, we're trying to focus in
Yeah.
on kind of areas that matter of difference, and it's my understanding that while experts might differ on whether to use the 60-40 approach, the actual rates that go into them, whether it's the band trust account or the long-term bond rate or this 10.9% rate, there isn't sort of differences of agreement on disagreement on that from my reading of the reports, and maybe I've misunderstood the reports, but yeah, that was a confusing question.
Yeah,
And I apologize.
If your question is there kind of numbers disagreement or methodological disagreement? I
Yeah.
think it's more the latter. Professors Beaudoin and Smart, there seems to be a small disagreement about this Ontario Canada issue, and they did point out 2 or 3 years where we had different numbers. 2 of those were typographical errors in my report. I recorded it 2 as a 3 and a 3 as a 2. I think I corrected those in my reply. And then one was actually that I had adjusted for the fiscal year. So that was why we had a difference. I think they had a full year return. I had a partial year return, but none of those 3 little points, are significant compared to forestry or transportation. But I think that's a fair characterization that it's the choice of the approach rather than the numbers in each approach.
Okay, let's continue.
Sure. I also wanted to just talk briefly. This is slide 216. I did a calculation using band trust accounts. That's the column BTA that is shown up on some of the tables. And this is just taken from the manual for the administration of banned monies, and it's available historically back to 1867. At various points, the rate was fixed. Then it seemed highly correlated with Canada long-term bond rates, and then more recently has been fixed to match yields on Canada bonds. Before 1867, I assumed it was flat for the 17 years before, which is, roughly consistent with other government debt instruments at that time. But I'm not sure there's a disagreement on the numbers, but just rather, should one use band trust accounts?
All right.
Okay.
So the next slide actually has to do with some questions that Canada's lawyers asked Professor Stiglitz. And I thought it might be a good idea to try and unpack the discussion about depreciation, trying to bring some clarity to not clarity, to identify how it is you come to the conclusion that Booth and Kersner use a 10.9% rate of return for equities.
So Professors Booth and Kersner use a 5.4%
Oh, I'm sorry.
return for equities.
I apologize. How, well, listen, why don't I ask you to
Sure.
try and explain the depreciation? I couldn't even ask the question properly, so I apologize.
Sure. So no worries. The first screenshot there is a snapshot. I'm on slide 217. Is a snapshot from Professor Booth and Kersner's report about how they calculate their nominal rates of return. So this is operationalizing the real rates of return and the depreciation that Professor Stiglitz spoke about last week. So as they say, the annual rate of return for business spending, I'm just reading the quote, is calculated as a real rate of 1.082 times 1 plus inflation times 0.95. That's a formula. Inflation, I think as the discussion went last week, 2-3%, somewhere in there over this period. So for this illustrative calculation, I've used 2.5. So that's the first bullet point of text, if you will. B and K nominal, to quote them, annual rate of return for business, which they discuss in their report, is based on equity returns. And
Can you, if you look at that first bullet point, can you tell me what each of these numbers?
sure, absolutely.
Is,
So the
please.
1.082
Yes,
is their real rate of return. It's a real rate of return of 8.2%.
it's real from what, though? Where is it? It's the rate of return from
For
what
business.
level of investment
For business.
for business?
Yeah.
Oh, that's it. That's a
Right, they
a
have
picture of the world.
4 categories, exactly.
Okay,
Okay, that's 1.082. The 1.025 is 1 plus inflation. So if inflation is 2.5%, we'd express that as 1.025. Now, why do we need inflation? Because the 8.2 is a real rate, and to make it a nominal rate, you have to adjust it for inflation. It's following their formula.
Mhm.
And the last term times 0.95. That's what they have in their equation in that first snapshot, 0.95. The footnote there explains that this is their depreciation factor. Sorry, the footnote I have pasted under the text. So
got it.
the second screenshot is the footnote on that page, the little 52. Does that make sense?
Yep, thank you.
Yeah.
So the 0.95 represents a 5% depreciation rate.
That's correct.
Okay.
And so you multiply those 3 numbers together, 1.082 times 1.025 times 0.95, and you'll get an answer of 5.4%. Technically, you'll get 1.054, but you just throw away the 1 and you get the 5.4%. So that's the nominal return that Professors Booth and Kersner apply to the NCRRs. Now, if you don't include this depreciation adjustment, which is what Professor Stiglitz explained, and I'll explain again now, is already included in those estimates of rates of return, you get 1.082.
In the rates of return, it's in the 1.082.
Yes. So this is the kind of double counting of depreciation that Professor Stiglitz spoke about last week. If that 1.082 was estimated from returns net of depreciation, which it was, then it's inappropriate to deduct depreciation again.
It's inappropriate.
Inappropriate. So this is what I have on the second line here. If I don't include their depreciation adjustment, I get 1.082 times 1.025 equals 10.9%. There would be a 10.9% nominal return if we didn't include depreciation. And that number is consistent with the number from Professor Booth's paper where I calculate the equity risk premium. That's the number I bolded in red at the bottom. That's the annual rate of return on TSE, Toronto Stock Exchange equities from 1926 to 2018. So that's saying if you had bought, a bunch of stocks on the Toronto Stock Exchange and held them, you would have earned 10.9% return.
Or 10.85%.
10.85% return. And if you own a stock and it pays you a dividend or you have a capital gain, you don't have to give 5% back to the company to cover depreciation. You get the 10.85%. If the company has had to invest in factories to earn that 10.85%, it's already counted the depreciation. Yeah, so the 10.85%, that's the money the investor gets. They don't then separately have to fund depreciation again. So this is the problem with the double counting of depreciation. Is that
All right, I think I actually understand it now.
Oh,
Thank you.
okay. Okay.
So now we're going to turn to, I guess, some revenue issues in your reply report.
Yeah, there are, I think I foreshadowed at the beginning of the NCRR analysis, there were 3 revenue items that weren't quantitatively significant, where I have a disagreement with Professors Beaudoin and Smart. One of those is Spectrum, which we spoke about yesterday. And then the other 2 are mining profits tax in 1935 and logging tax. So I'm going to speak briefly about each of those. So what is the issue in 1935? 1935 was one of those fiscal years that we changed. So the fiscal year 1935, well, the 1934 fiscal year ended on October 31st, 1934. And the 1935 fiscal year ended on March 31st, 1935. So it was a short year. We moved from October to March fiscal years. So there's a 5-month period. And then, every year thereafter, we've had a 12-month period. So in the public accounts for 1935, there's no entry for mining profits tax. There's not a 0, there's just no entry. And in 1936, the statement of accounts is for the fiscal year ended March 31st, 1936. So there's 2 possibilities as I see it. One is no mining profits tax was collected in that 5-month period. 2 is that with the change in accounting things, they didn't fully publish all the details. I looked at the data to see which one of those made more sense. So if you assume the money collected in 1936, there's 2 assumptions, right? So if I look at, it's labeled row C there with 1936, 1,400,000. There's no disagreement that that money was collected in 1936. If that money was for the 17-month period ended March 31st, 1936, so it covered the whole year plus the little year, there's 17 months. That's what Professors Beaudoin and Smart assume, shown in column 4. The implication of that is that on average, mining profits tax is being paid at a rate of $82,000 a month That's in column 6. Now, the other alternative is that that just covers the fiscal year, which is what I assume. And if you divide that 1.4 million over 12 months, that means there's $116,000 collected a month. On their own, neither of those quantities necessarily mean anything. But when you look at the trend of the years before and after, so I plotted here 1930 to 1940, you can see 1931 was 40,000, 1932 was 43,000, 1933 was 57,000, 1934 was 89,000. Then 1937 was 130,000, 1938 was 150,000, 1939 was 227,000. These are all provincial-wide numbers, and there's a pretty clear upward trajectory, which we might expect as mining expands. And looking at that, the 116,000 I calculate for 1936 fits that general trend a little better, which would mean it's consistent with 1936 only covering a 12-month period. And given that, I then impute an amount of 1935 that would continue that smooth line. If you make the other assumption that it's covered the whole 17-month period, you have this little blip. So if you go down column 6, it would be 89,000 per month in 1934, then 82,000 per month for 35 and 36, and then it jumps up to 130,000.
So this is one of those smell tests, eh?
A little bit. I mean, in the absence of data, kind of smooth line makes a little bit more sense. I mean, mining is taking off during this time period. Like soon these numbers become significantly higher. And the idea that there was a dip and then a big jump up just didn't seem to fit the data very well.
Now, I recall, is this a complaint, or I don't want to call it a complaint, or a criticism that in Bodway and Smart's report, do they say that you made a $500,000 error? Is that, that's,
No, I think,
that's not involving this particular interpolation issue?
no, I think they make a statement that I've imputed something like 500 million that doesn't exist. Is their
That's half a
statement.
million?
500 million, yeah,
Oh, 500 million.
yes,
Sorry, that's for this issue here?
yes.
So, maybe I think in their report, if we take a look at the Bodway and Smart nominal values report at paragraph 62. I wonder, Ms. Lewis, if you can pull that up. I want to know if this is what, if I've got the right place.
Yes, so Mr. Hutchings, yes, this is the right place.
Okay, so
Um,
let's continue on. Let's read that. Mr. Hutchings record, this is a criticism of what you've done, and you've just tried to explain what you did. Mr. Hutchings records revenues from the mining tax in 1935, but as a result of a change in the government's fiscal year end that year, no mining profit tax revenue was actually reported in the PAO for that year, period. Instead, revenues would have been higher for the 1935/36 fiscal year. And there's this statement. Mr. Hutchings' imputation for 1935 has no basis in fact, and it results in a double counting of revenue, including interest to 2020 at Mr. Hutchings' preferred rate of interest. We estimate he has overstated provincial mining revenues by over 500 million as a result. And could you respond, how real is that a fair criticism?
Could you please tell me the name of this report?
It's the Bodway and Smart nominal values report.
Is it must be a reply, right? Okay. thank
Oh,
you.
sorry, net Crown resource-based revenues in the Robinson Huron and Robinson Superior Treaty Territories.
Okay, thank you.
Yeah. Now, I call it the nominal values approach, but I didn't realize the title wasn't nominal values approach.
Yes, that's the paragraph I'm referring to. So I think there are a couple of things to say in addition to what I just said. First, as we saw, the monthly revenues in 1935-36 are lower, not higher, if we make the assumption that Professors Bodway and Smart do, that 35-36 includes all the revenue. This is the 82,000 versus the 89,000. The first passage you read said you'd expect the revenues to be higher, but the data show that they're lower. But perhaps more to the substance, the 500 million number is Ontario-wide at my 60-40 interest rates. The nominal amount is the 515,517 shown in column 3 for the year 1935. And of that amount, I allocate.
Just let me say that the nominal 515, not 500 million, 515 is province-wide?
That's province-wide.
Okay,
And of that amount in this year, I allocate $258 to RST.
$200
58.
not 258 million, not 258,000, $258.
That's right.
So it would be fair to say Bodway and Smart's complaint is a $258 nominal complaint.
Yes. I thought about it in those terms, but I think that's right.
Did you want to, was there more to say about mining profits tax?
No.
Okay, so then we would go to logging tax.
Yes. So the law.
Oh, I just have one
Yeah.
question. So this illustration, but for the criticism, I'll put that aside for a moment. This illustration, slide 219, is simply an illustration of why you want to persuade the court why your approach to 1935, missing data for 5 months, 1935 is more correct.
Yes.
So all focused on 5 months in 1935.
Yes.
Okay.
Right, so the logging tax, this is a revenue source I include from 1951 to 1980. The logging tax was a form of tax on the profits or corporate income tax on logging companies in this time period. Professors Bodway and Smart do not include this revenue item because, in their words, it was implemented as a replacement for corporation income taxes on logging profits. And to be a bit more specific, what does that mean? Because you could say income taxes have been a replacement on direct resource revenues, as we've looked at over the last 100 years, that there was a credit given or it was deductible against income tax otherwise owed to the federal government. So I saw that rebuttal point. I replied in my report. I don't really see how the interaction between two different income taxes levied by Ontario and Canada, are kind of determinative of the test of, did this revenue arise in a closely related way to the use of the land and resources? In general, the corporate income taxes, as we've discussed, the indirect taxes, are kind of blurred together. And it's only because of the practical difficulties of separating them that we don't include indirect tax revenues. In this setting, if you're going to levy a specific tax on a company engaged in logging, it seems that the Crown has kind of helped out and done that work of then this is then you put a number on what is the direct Crown resource revenue you could get in this zone.
Just so I understand, Ontario levied a tax that could then be deducted from their federal income tax.
That's correct. So I think Professors Budwin and Smart put it that the effective tax rate was the same, it was just a reapportionment.
So the dispute is whether to count
The logging tax.
the logging tax.
That's right.
And do you know how the logging tax worked?
Yeah, it was a tax on profits. I forget the rate, maybe 6 or 9% on the profits of companies engaged in logging activities.
So you had to have a profit from logging activities.
Mhm.
And then there was a special logging tax.
That's correct.
And
Let me just say, that's not dissimilar to like the mining profits tax. If
Right.
you do a certain thing and make money, a certain portion of that is taxed. But it's specific to logging, you know, if you're engaged in automobile manufacturing or legal services, you don't pay the tax. Okay,
and
it's for completeness.
and so your view is that logging taxes should be in. Can you give us a flavor of how how big of an issue the logging tax issue is? In terms of quantitatively at the end of the day?
Not for RST, I don't have that handy. I'd have to look at
Okay.
my work papers, but I could get you that answer very quickly.
Okay,
Okay. Say not major points. And now in reply, carrying on with some of the expenses, you know, we've talked about, I think, the big ticket items of fire, forestry, and transportation. But I think more generally, I just want to highlight how some of these expense ratios kind of work. So Professors Bodway and Smart focus a lot of their criticism of my expense analysis on what happens after 1945. And this is one of the figures they include in their rebuttal report. That same report we just talked about, the nominal report, Mr. Schechter called it. And they use a figure like this one, which is share of resource department expenses included, our approach versus plaintiff's experts. This is figure 7 of that report, and this is on slide 222 of my deck. You know, to show that, as they describe it, as time goes on, I include a very small portion of the expenses of these resource departments. Excuse me. I don't disagree, but that's not because of my method about allocating expenses. A large part of it is about the Crown not collecting revenues and or the Crown engaging in those other activities that might support other revenues. So that, you know, the best example of this would be forestry that we talked about earlier. The expenses of the Minister of Natural Resources have gone up a lot, the like 600 million we looked at for forestry, even though the direct revenues have stayed largely the same over time at 27 million. And so, you know, the fact that I'm including a portion of revenues, and revenues are a almost de minimis portion of all those expenses, I don't think really says anything about my method, or the fact that they include on this graph, you know, 40 to 60% of those resource ministry department expenses. If the ministry or the department is doing lots of things unrelated to direct Crown resource revenues, kind of ex ante, you wouldn't know or have any prediction about what this graph should look like. So the fact both lines go down, I don't think it's that informative. I think a better way of looking at it, given the guidance that expenses have to be tied to revenues, right? We want that balancing, is how do we express expenses relative to those revenues, right? That's the test. And so the next slide, slide 223.
Just before we get
Yeah,
there,
sure.
would this be an example of them saying your work doesn't pass the smell test?
Yes.
They say you take a look at the way Mr. Hutchings counts, doesn't make any sense.
Yes.
Okay.
I think that's what they say about this, that share is so low. In their opinion, that can't be right. slide 223, I think, again, given this whole exercise of marrying revenues and expenses to make a meaningful net comparison, it's a better way to look at it is how do the expenses compare to the revenues we're counting? Not how do the expenses they're counting compare to the expenses of a department that does many other things. And Northern Development was another example we looked at earlier. The Ministry of Mines has been married to Northern Development for a long time, and we both agree none of that is relevant. And then you get a chart that looks like this.
Like this on slide
Slide-
223.
Slide 223,
And whose data is this?
Professor Bodway and Smart's data. It's the expenses they include, ministry expenses divided by revenues. And what I bolded here is at 100%. So what does that mean? If the blue line is below the orange line, expenses are less than revenues. So there are positive NCRRs. So a couple negative years in the 30s. And then after 1960, it's all negative. And the blue line is above the orange line, there are losses. And it's all on the same scale, so these offset. And in some years, there's more than 10 times the expenses as the revenues. And this is, again, illustrative of the trend going up. In my mind, this is a more informative way of looking at that smell test of, let's have something meaningful in the denominator rather than the denominator being all the expenses for all the activities of the department. Let's compare it to the revenues. And so, my line being generally below the orange line, I haven't plotted it here, but that's where it would be, to me, is a more informative comparison. The next slide, figure 8 from their report. This is slide 224 in my deck. This is where Professors Bodway and Smart talk about the rising cost of government generally. They suggest, or they opine, that expenses have gone up because it's become more expensive to run government. And they point to this comparison between resource spending. So what's on this graph? Maybe I should start with that. The blue line is total government spending in real dollars, so that's adjusted for inflation, per capita. So, I don't know, 1945, it looks like the blue line is around 1,000. The government spent $1,000 per person in Ontario. The red line is resource spending by, not resource spending, spending by the resource ministries only in real dollars per capita. They point to resource spending growing more slowly than the total, and then it being stable while the cost of government generally has gone up. And I've mentioned a few things in my report about this. Spending generally, without tethering it to revenues, I don't find to be particularly informative for this test. And spending per capita, maybe for total government spending, makes some sense, right? Like how many more services are government providing? And during this period, this 100-year period, we have healthcare, we have education. We're spending lots of things on the citizens. Our government spending has gone up a lot because we offer a lot more services than in 1919.
More programs.
More programs, more everything. But resource spending, having a relationship to the number of people, kind of doesn't make any sense to me. Again, logically, I couldn't say how that line should work because I would hope that resource spending would be more connected with resource activity. Whether or not there's another 500,000 people in Ontario and whether they're in Toronto or Sudbury would all get blurred in this. Doesn't matter where the people are, just where are they in Ontario. I would expect instead, resource spending based on the number of mines or based on the acres of forestry we're harvesting. Those would be perhaps more meaningful comparisons of what is the cost of supporting those resource revenues.
Now, is this another one of those kind of smell tests, this graph, that they're trying to portray something here? Because I looked at this graph and I see there, looks like expenses, there's rising cost of government's going up. Well, so is the cost of cost of resource spending. Kind of looks like they're kind of matching.
Yes.
Are you
And-
saying parallel lines? They look like they're
Well, they're
parallel
going
lines.
up, they're both going up kind of equally. And it's
Yeah.
telling, I'm wondering if they're trying to tell a message here about
Yeah.
what you did wrong, like a smell test.
I think that's right. They would characterize this as another smell test. But you know, if we look at the text boxes there, they say resource spending grew more slowly, 1946 to 1972, and it's been stable after 1973. So I think what the chart's really showing is resource spending hasn't gone up as much. So to the extent there has been explosions in the cost of government, it's not in the resource departments. But
Okay,
you raised the parallel line point, and that maybe this is where you want to go next. The axis here is not a linear axis, it's a logarithmic axis.
what does that do
Well,
to how things look?
sure. So if you look at, so it starts at $10. Then the next tick mark is at $100. Then it's at $1,000. Then it's at $5,000. And then it's at $10,000. Now what that means is if you plot a straight line, that is a constant rate of growth. Because of that. So basically, if you plot a straight line here, that would be an exponential chart on a spread out axis. And that would be a constant rate of growth because, you know, if you get 5% a year forever, you know, you get one of these sorts of charts. Sorry, I'm drawing like the hockey stick curve chart. I guess, sorry, from your perspective, this way. So straight lines translate to that. And flat lines are flat. But, you know, what that means is, yeah, I mean, that explains the axis. But if you want to then plot it in maybe the way most of us see graphs, you'd see this slide, which is 225, which is plotting it on a linear axis. And so that's what I mean. Like if you look at the period 1960 to 1972, you see how there's that kind of scoop exponential shape. That translates to where the line was flat on the prior chart, or not flat, but was a straight line. You know, it looked kind of straight, but what straight means is like this. If that makes any sense.
Like this doesn't.
No, I
what
know.
did you mean by like
The
this?
exponential where you have that curve.
Where you-
So
Okay, an
if you
exponential.
compare 1960 to 1972, on slide 224, that looks like a straight line going up. On line 225, you know, it's an exponential growth. So if you're concerned about rates of change, logarithmic graphs can be helpful. But again, it shows on either reading that resource ministry expending per capita is flat after 1972, while other government spending has more than doubled.
Sorry, so the blue line is, let's just, for clarity's sake, on slide 225, there's a blue line and a red line. What's the blue line again?
Blue line is total government spending per person.
Yes,
The red line is spending by the resource ministries. So what I'm suggesting is that from 1972, the dashed lines, until 2020, total government spending,
Sorry, the dashed line.
oh, sorry, there's a vertical dashed line that marks
Oh, yeah,
1972.
got it.
You know, if you look to the right of that, total government spending per person has doubled. It's gone from about 5,000 to a little over 10,000. And resource ministry spending has stayed flat. You can,
Has doubled from 1972 till now.
yes,
Got it.
right, and resource ministry spending has been stable. You can see that on the prior graph, but you know the doubling is all limited to the you know you can see the blue line still only goes from 5,000 to 10,000 on slide 224.
Mhm.
You know it covers a small part of the chart. So you know the rate of change is higher than, but the red line has stayed completely flat. You see it's 100 at the beginning, 100 at the end of the red line,
Right.
while the other one has doubled. So to the extent per capita is a meaningful way to measure it, it shows that the general problem of government spending going up, not general problem, the general phenomenon of government spending going up has not affected the resource ministries after 1972.
Thank you.
General phenomenon of increased government spending has not been driven by resource ministries.
Yes.
In
Much
your
more
work as,
parsimonious way to do
in,
it.
in your work as an economist, do you know what has driven up those expenses per person or?
Well, part of it is the, increased suite of services that government is providing in terms of healthcare, Medicare, et cetera. There's also some spillovers from the private sector. I mean, Professors Bodway and Smart talk about, I think it's Baumol's cost disease that does affect labor intensive things and would be particularly pronounced in things like healthcare, social services, education, which is a large part of what the government spends money on.
What did you say they talked about?
Sorry.
Baumol's
Baumol,
disease?
that's
What's that?
Baumol as a professor. It's a phenomenon about how spending in labor-intensive industries can affect government spending. I don't know, cost disease, it's just the label that's been put on it. But they
It's not
discuss
like spruce budworm.
no. No one has to get anything amputated or cut down. It's just a phenomenon of increases in
remember
productivity
this,
in the private sector can drive cost increases. And as Professor Baumol discusses, that's particularly so where, in his words, labor is the output good, or where it's a labor intensive service. So as I say, healthcare, education, social services.
Yes,
Does that make sense?
I recall that now from the report.
Okay.
So we get now to the surreply. Are you addressing the surreply of Professors Bodway and Smart? And so I would like to get through some of this before the day's over.
Okay. So, yes, I received a surreply report, I believe it was early December 2022. And there's just a few topics that have probably make sense to discuss because I haven't had a chance to write a report in response to that. So I want to start with 2 points related to outdoor recreation expenses and transportation expenses, where Professors Bodway and Smart amend their results in response to my reply. So 2 of the points in my reply, one was about, as I say, outdoor recreation expenses, I said should have been excluded, but they were included. And they agreed. That was part of a larger criticism, but they agreed with this part about outdoor recreation expenses. And then in their transportation expense analysis, I had methodological disagreements, as we discussed yesterday, but I also pointed out some smaller computational errors in their work. And they agreed, again, in part, they agreed with one of them. And in their surreply, they gave the effect on their risk-adjusted present values, but they didn't update all of their calculations. So before I discuss the rest of my responses to their surreply, I want to just update that they have, the gap between us has narrowed a bit just based on this, if that makes sense. I just want to be fair. So I got their work papers last week, I suppose, and with that I could update some of their calculations. So this is slide 229. So the first row is their rebuttal report from the summer, and the second row is as revised based on their treatment of outdoor recreation expenses and transportation. So the impact is that the estimate of net Crown resource revenues in nominal terms has gone up 243 million. At their preferred rate of return of the long-term bond rate, it's gone up 2.6 billion. And at my preferred rate of return using a 60-40 equity to debt model, it's gone up 8.7 billion. So there, in the subsequent slides, I just wanted to note that when I talk about the scope of our disagreement, it's a little narrower.
Right. But what we're going to talk about now is not part of that. I'm going to speak in nominal terms, 243 million.
That's correct. I'm not going to talk about the point where they agreed. I'm also not going to talk about a couple of critiques I made in my reply that they didn't reply to in their SIR reply, either affirmatively agreeing or continuing to disagree. I'm not going to talk about those. I'm just focusing on the renewed disagreements in the SIR reply.
Okay, thank you.
So the first is what I called the Fish and Wildlife error from 1997 to 2011. So in my reply report, I pointed out, find the paragraph if you want, but that from 1997 to 2011, they included in their analysis certain expenses for fish and wildlife management, even though we both stated in our reports that in general, we agreed fish and wildlife management should be excluded. In their SIR reply, the quote is here, Professors Beaudoin and Smart state that I state that we included fish and wildlife. I guess I should just read it as written.
Yeah.
Mr. Hutchings states that we included fish and wildlife management spending in the 1997 to 2011 period. This statement is categorically incorrect. We did not include this item in our accounts. Mr. Hutchings simply failed to understand the computer instruction files that we included in our work papers.
And now you're going to take us through some slides that actually demonstrate the error.
So I guess my preliminary response is the error wasn't in their computer instruction files. It was in their input data. So I continue to believe I understood and understand their computer instruction files, and I'll show on the next slide, but the error really started in the input data.
And perhaps with that teaser, we can have a break. Probably a good time to break.
At the end of the afternoon, we need a, okay, so we'll take a quick break. 15 minutes.
15 minutes.
This court will recess for 15 minutes, returning at 2:55. This court is now resumed. You may be seated.
Mr. Schachter, before you start, the hard stop today, is it for the witness? Does that include the witness?
It is for the witness, yes.
Okay, I might have some questions for counsel that if it's past 4 o'clock, we can still excuse the witness. Although maybe you're involved in transportation.
Yeah, I think we have a little time as well. I think a number of counsel are also, because the witness has to be on the plane, they're going to be on the plane as well. But we have some time.
I know how that works. Okay.
Okay, so just before the break, you told us about how there was a complaint that you had categorically incorrectly misunderstood computer codes. And although it's not as miraculous as turning water to wine, Mr. Hutchings, you're going to tell us how Ontario turned fish to wood. Sorry, I had to go there.
This is
Mixed metaphors have nothing on you.
a very tall order. Perhaps I'll just take us all through some rather boring computer code files. Okay,
Good try.
I'll try. Okay, so if we can turn to slide 232. I'll try to get us through this. So the first screenshot there is from their expense file that we've looked at before. So we've seen this format. This is their input data. So columns A, B, C, and D are how Professors Beaudoin and Smart characterize their data. And then column E onward is the transcription. You see in column E here, there's an item called Fish and Wildlife Management. I've highlighted the years at issue. 12 million, for example, in 2000, 28 million in 2001, and so on. So that's transcribed from the public accounts. It's transcribed correctly. The issue comes in the 4 columns on the left. The ministry is recorded as Ministry of Natural Resources, MNR. That's correct. The category is recorded as forest management or for MGMT in their analysis, which is not accurate. And then the ones that the computer code relies on are the next two columns. The resource is wood, which is what they used for forestry, and the exclusion is 0. And we'll remind ourselves that exclusion being 0 means it's included.
Included as an expense.
Included in full as a relevant expense.
Okay.
Now, looking at their computer instruction file, this is the snapshot of the next snapshot. And there's some weird old typewriter text that's colored on the left. This is from a Stata do file. And do is just the
Sorry, do,
D-O.
you're holding up your quotation, so it's D-O in quotation marks?
Yeah, so Stata is the computer program, S-T-A-T-A. That's a pretty standard statistical program. And they're called do files because we're not very inventive and they do things. So the command is actually do and then the file. So here's a section of that code where they have some catches, if you will, to catch some transcriptions or to potentially catch some errors. So let's look at the 4 that are relevant here. You see they have this comment. The first line is green with an asterisk. That's what's called a comment in the code. So the computer itself doesn't do anything with that. This is just written to somebody like me coming along later. You know, what were you trying to do here? This is fish plus game excluded in all cases. And then there are 5 instructions or 4 instructions that follow. This is slide 232 on the left. So the first is replace category equals fish exclude if resource equals fish. What does that mean? Well, let's take it backwards. If the resource is labeled as fish, then they change the category to fish exclude. So this would be an example of, say, in column B, it was labeled forest management, but fish. That was the typo. Then this would catch that and say, no, it's no longer forest management, it's fishing, so exclude it. But because they've labeled it wood, this if statement doesn't apply. The next line says replace exclusion equals 1 if resource equals fish. Again, because the resource has been labeled as wood, it doesn't get caught. The next line says to replace exclusion equals 1. Remember, exclusion 1 means exclude, not relevant. If ministry equals DGF, which is Department of Game and Fisheries, sorry, the acronyms escaped me for a minute, but because it's been labeled as Ministry of Natural Resources, it's not excluded.
So when it says replace exclusion equals 1, so you would replace it to be 1 exclude.
Exactly. So you're gonna have to read it backwards, right?
Yes.
If ministry is Department of Game and Fisheries, then set exclusion to 1. So if it's in Game and Fisheries, exclude it. But because it's been labeled as MNR, it's not excluded. And then the last replace there is replace exclusion equals 1 if category equals land water. Again, because the category has been labeled forest management, this isn't caught either. So that's the issue. And the last snapshot there, it kind of looks like a even more hard to read Excel table. This is a snapshot of the Stata file. The specific one here is provexpense.dta. That's just the file name in their work papers. But I've highlighted in red the kind of problematic row, which you can see as fish and wildlife management, MNR, categories forest management, resources wood, exclusion is 0, and the amount is 12 million. So this is kind of the first stage of that computer code file. Okay, so the computer code has gone and read in this data and done this first step, and this is what you get.
So you say there was an error made in this second red box and it wasn't corrected because the corrections in the box above were designed in a way that didn't catch it.
Exactly. That's what I'm saying. You know, it all stemmed from the top having it be would and included.
At the top and the bottom then just replicates the error.
Exactly, exactly. That's exactly right. So, computers are very smart. I mean, they do millions or billions of calculations a second. They're very diligent. They do it the same way every time, but they're not creative. If it's been mislabeled, they don't know that it's been mislabeled.
Why did they say you missed that? Why did they say you got it wrong instead of their instructions?
They don't. They say I failed to understand the computer instruction files.
Right. That you didn't understand the
That's
files.
correct.
You say you do understand the files.
Yes. And I'm going to show that if I make the change I say they should have made, their end result changes. So the error is not caught somewhere else as well.
So does that take us to the next screen?
Well, no, the next slide, I wanted to double check. If we go back one slide, I focused on the problems on the left, right? That this has been categorized as a wood forest management expense. I wanted to check that the Fish and Wildlife Management label was right. Sometimes Excel, you type something in, it auto fills. So maybe this $12 million was not Fish and Wildlife spending. So I went to the public accounts, that's on the next page.
And we know that there's general agreement of all the experts that Fish and Wildlife is not an expense that is deducted from the revenues.
That's correct.
Okay.
And specific to this year, Professors Bodway and Smart say they do not include the item. So this is the public accounts for 2000. And you can see, this is a snapshot from the Ministry of Natural Resources. This is slide 233. Fish and Wildlife Management, and there's the total at the bottom, $12,091,168. So that's the same amount.
Sorry, you may have said this, but what's the extent of this error? Is it just 99, 2000, or is it?
It's 1997 to 2011. That's why I say it's really just that one line item. In other years, it's properly excluded, but for these 15 years,
okay,
it was labeled as wood instead of fish. But that's why here's the public accounts, and here's the 12 million. Right, it's the salaries, employee benefits, etc., under Fish and Wildlife Management. So now let's flip the page to 234. Let's leave the door open that this wasn't an error and that there was some other piece of code that would have caught this before the final results are generated. So I do that by going into their input data and I change it. I change would and include to be fish and exclude. That's what's highlighted in that second row. So it's kind of the before and after. If that number was never included, me making this change shouldn't change anything. I see that if I make that change, it gets propagated through their data set. This is the green circling at the bottom. You see that now it's fish and one. And when we run it all the way through, I've just, on the next slide, I show making this change. Here's the impact when I calculate their net ground resource revenue numbers. And it increases by $52,590,300.
And that's using their long-term bond rates.
No, this is in nominal dollars.
Oh, this
It's
is
a typo
nominal
at the
dollars.
dollar. Yeah, it's a
Okay.
typo at the top. This is from the years 97 to 2011. Let me say this 52 million fits into that kind of bucket of other things that aren't forestry and transportation, but given their statement.
I wonder if we can take a look at slide 235. It says the table below shows the impact of the corrections on Professors Bodway and Smart's
Yes.
NCRR estimates using their long-term bond present value factors. And I thought you said it was nominal.
It is nominal. That clause is a typo.
Okay,
Sorry.
so the typo is using their at nominal rates, not using long-term bond rates.
So the type should just be to delete the words using their long-term bond PV factors. If we just delete those,
Yes,
it's good.
okay.
Apologies.
No, that's fine. Better we clear it up now.
Yeah, of course. So another topic is the treatment of, I'll say, gross versus net expenses. And you might say, what is this about? How we did everything gross and then we netted it at the end. I'm on slide 237 now. In my reply report, I raised two concerns on this topic. Let me say what both of them are, and then I'll explain their SIR reply, and then why I'm here to reply to that. So first, they made a statement that the percent of expenses they include from the resource ministries has generally declined over time. I did an analysis where I separated them by ministry. So I looked at, because the big one that has declined is the Northern Development Ministry. And I said, no, they'd actually included 94% of revenue of expenses in the Ministry of Natural Resources as they measure expenses in that big expense spreadsheet we looked at a few times. That was one thing I raised. The second thing I raised was when it comes to allocating overhead, because they do the allocation on the costs net of recovery, they were over allocating overhead. What do I mean by this? Let's take Ontario Parks as an example. The Ontario Parks expense item in the public accounts often includes the cost recoveries. So I have an example in my reply report. There might have been a year that Parks spent $100 million, but they recovered $90 million. So the net of cost is $10 million. Now, if that's one of our factories, it makes a difference if we base it on 100 million or 10 million when we allocate. And I said by using net, they had underestimated that share. Okay? And that does affect the calculations of net crown resource revenues because it affects the calculations of overhead, right? If there's a
They're using net before they do the bigger calculation for net.
That's correct. That's correct. Yeah, that's a good way of putting it. So I raised those two criticisms. In their SIR reply, they say the 94% number I calculate for the share of included expenses is either wrong or misleading because they exclude also these gross things and it should be done on a gross basis. They don't, I think, reply to my criticism about how they allocate overhead. So they produced this table. This is a table on slide. You can't see the number on this one for some reason.
Number seems to be missing on this one.
239. One between 238 and 240.
Let's average it out.
Yeah, exactly. We've interpolated the numbers. This is table 1. So this is from their SIR reply. And they're saying the 94% number or the 6% exclusion number I calculated was misleading. It should be this number at the bottom, 37.5%, correcting for gross expenses. Now, I have issues with how this 37.5% is calculated, but it's not really relevant for the main criticism, which is in showing all these, what they call about the middle of the table, additional gross excluded expenses reported on net basis. That's the problem that affects their overhead calculation. Now, what is that? That's a lot to unpack. Additional gross excluded expenses reported on net basis. What that means is that there were additional expenses in fish and wildlife management, parks, and land and resource information, as shown here, of $2 billion gross expenses that were offset, if you will, by user fees, etc. And so that's not included in their net number above.
So could you point to which
Yeah.
numbers, please?
Sure. So the first line 1 there, ministry total expense, is over this 10-year period. They're saying there was $6 billion, $6,145,000,000 of total expense at the Ministry of Natural Resources and Forestry. They exclude net expenditures of 257,817,000. Now, in the text box on the side, I've done a calculation which shows that means they include 95.8%. That's the 6,145,000,000 minus the 257 million divided by the 6,145,000,000. That's the number they say is misleading because it doesn't include these gross adjustments below. But that's my point. If you include those gross adjustments below, the grand total of excluded expenses is in the bottom, as Professors Bodway and Smart calculate at row 7, 2,304,000,000. So the issue is the overhead in their calculations is based on the first two rows. So there's kind of a $5.9 billion factory and a $257 million factory. The 257 is the excluded. So when they do their overhead, they allocate, no, kind of 95 or 96%, 4% way. But if really, as they're showing now in line 7, there was 2.3 billion excluded, and by excluded, we mean not relevant, then you should have allocated it with 2.3 billion. So that excluded factory is a lot bigger, almost 10 times bigger. And so the overhead you allocate to that bucket should be higher. And that's what I pointed out in my reply report using different data. But I take this table as agreement that gross expenses is the way to go. But I don't see an update on the overhead calculations. And slide 240, the next slide. This is another zoom out of this table. We've seen of theirs many times. I'm just highlighting at the bottom the percent included. This is a calculation they do in their work papers.
Everything except the red box just is the way it came to you?
That's
again?
correct. Okay. That's how they report the percent included, but 91 to 99%. So the 95.8 I did on the prior slide is in keeping with that.
So just to go back to 240, just so that I can understand it, the percent included is the percent of costs that they include as expenses? Or how would you describe that? I'm not sure I captured it.
So it would be what they consider the relevant expenses as a percent of all the expenses. So if the ministry spent in that first year $628 million, they include $593 million worth as deductions against NCRRs.
And do you think that that's right or wrong?
No, I think that's wrong. For a number of reasons I discussed earlier, this is the forest allocation issue, but more specifically here, the implication of this high number that should be a lower number as they show on the previous slide is that you end up allocating 94% of the overhead instead of 60-something% of the overhead. So there's a follow-on effect.
Right. But you don't agree that they should apply 60?
No. This is just limited to, I'm replying only to the things they raise in their SIR reply.
So there's some differences in expenses between in 1898 to 1945 that you want to highlight, I take it.
Well, so this is a table, as I say, they've undertaken, I guess, a reconciliation effort as well between the differences in my data and their data to identify the big ticket items, if you will. The note to their table says the bulk of the difference is explained by just the 6 items in this table.
The bulk
now,
of the difference as between you on,
expenses.
not just forestry, on expenses, period.
Expenses, period. Yep. And a word on this table, it's data from 1898 to 1945. That's Ontario-wide and brought forward to $2020 at their long-term bond rate.
And this is slide 242.
242.
So the 8,159,000,000 is not nominal dollars at all.
That's correct. And I guess there's a couple of things I want to address in this table. The first is what I've circled in red. I include 100% of survey expenses in my expense analysis. As we showed earlier, I also allocate more survey expenses to the RST than they do. And I'm not sure this, I don't believe this was a criticism raised in their rebuttal report, but I went back and reread my opening report to double check that I stated that I had included them from the beginning. And that's the paragraph reference there, 117E of my opening report, where I say, quote, surveys, I include all survey expenses. So I'm not sure where this is coming from. And then I also want to note on the second item, expenses related to research, inspections, and mine rehabilitation. I include all the expenses labeled as inspections for mining. We went through some of our points of agreement on that yesterday, 1915 to 1920. So about half of that number we don't disagree on. In terms of what's left, I agree, those are some of the big ticket items. Fire management falls under forestry, and that's a big ticket item. And we've talked about that earlier. Air service, it's like an order of magnitude less, but our different treatment of air service, I think as I was explaining yesterday, is the hours flown, a big chunk of those is fire. So methodologically, I'm not sure we disagree that much on air service. If we agreed on fire management, I think we'd agree on air service. If that makes any sense.
Mhm.
Yeah, okay. And then reforestation and forest reserves, as I talked about yesterday. But I think those are also smaller amounts and they don't persist after 1945 or after 1947. So I think it's fair to say we disagree on fire management in a big way. And then more generally after 1945 on forestry expenses. But just wanted to clear up those first two items because it was brought to
Yes.
my attention on surveys.
So you want to address a double counting issue.
Yes, there were two other double counting issues I raised in my reply report. One relates to double counting of capital expenses from 1973 to 2019. And the other relates to a double counting of overhead expenses back in the 1920s and 30s. Sign I should have some water.
How you doing? How you doing?
I'm good. Yeah. I'm setting a new record. So what's the issue here on double counting of capital expenses? I've spoken earlier about how they sometimes have total rows and then all the sub items, right? And you have to make sure you count either the sub items or the total, but not both. And that's basically where this is going, that for a number of years, they count both. So I think the easiest way to see this before we get into the Excel files is on the next slide, like 244.
244?
Yeah, sorry, 245.
245.
Sorry. This is plotting two things from Professor Bodwin Smart's data. The big blue line is the sum of the ministry totals in their source data, which is that transcription file, the big Excel file that we've looked at a lot of pictures of.
So that represents 100% of the expenses?
That's right. That's the totals as they've transcribed them in the data. That is included, excluded, overhead. We're not even getting to that stage yet. We're just talking about how much money did the resource ministry spend. Okay. That's that one. And then the dotted green line comes from their Stata database after they load in the data and summarize it. It's the variable they call exp all, which is from their final data set, and it is the sum of included and excluded expenses across ministries. And you'll notice that the two overlap until 1972. That is, you can only see the darker blue line. And then from 1973 onwards, the green line is somewhat stubbornly above. So what that means is the totals in the database on which they run their computer code are higher than the totals in the input data. As I'm going to explain, that's because some of the rows were counted twice by the computer code. Okay. And this is just to say, if I go in and delete the rows, I think we're double counted. I get back the orange line for exp all, which, as you can see, sits over the blue line. So gives me some confidence that this is,
I can see that.
you can?
On-
Sorry.
on-
Oh, on the
on
next
slide
page.
246.
Sorry.
Oh, no, I was worried.
Oh, yeah. Could also be the printing. I think there's many things.
So,
we can attribute.
I mean, this is fascinating, but how did this come to your attention? I mean, how does, I mean, you're reviewing, I mean, did you review computer code? Did it intuitively come to you? I mean, how did this come to your attention? It's like you're catching, you know, pretty significant methodological, and that's pejorative, but you're catching a methodological error, I think. How did it come to your attention?
Yeah, so I didn't go line by line through every item in their expenses. You look sometimes at the totals and you think, you know, I like to think in my head, if I write it down on a piece of paper, like, oh, given the choices we've made, you know, we should be higher or lower by a little or a lot in these periods of time. And then you look at the data and say, doesn't seem to match with my hypothesis. And so maybe then you go and take a closer look. And then you get something like this where the totals seem different in two different places. And that's a sign to look. And look, it's a sign to look both at my own work and at their work, right? But maybe we got different numbers because I transcribed the numbers wrong. And I mentioned, like, in the present value factors, there were 2 years where there were typographical errors. There's a lot of data in this case. So I pointed this out in my reply, but they've taken some exception to it and come back in their SIR reply. So I want to walk through it in a bit more detail. I had an appendix of my reply report that goes through the screenshots we're about to go through. But that's how it comes to your attention. I mean,
Okay.
if it was smaller amount of data, maybe you'd review every single piece, but it's something with this magnitude. They're kind of looking for things that don't quite make sense. Okay. So in their SIR reply, Professors Bodway and Smart partially agree with this. They say that some of the expenses that they include should have been excluded from 1973 to 1991, but not the years thereafter. But the way they correct for it is to move included expenses to excluded expenses. This was the $243 million adjustment I spoke about earlier. They don't remove them from the total. So the fact that the totals still don't match will still persist within the data. So I want to go through why, you know, how it looks to be a double counting error, and then how we can fix it and get back those charts I looked at earlier. If that's okay. Okay, so here's an example from 1974. I'm using this example because I used it in the reply report. So what are we looking at here? We're looking at a snapshot of their expense file, their input data file. Is slide 248. You see the rows highlighted in orange. So they record some data at the top there: natural resource management, capital expense operations, capital expense, recreation, resource management, and protection. See the number 37,335,044.
I want to stop you for a moment. The explanation in words says, as explained in Appendix A. Is this, when you say Appendix A, this is verbiage you took from your report? Is that why it has?
Yes,
Appendix A?
sorry. These screenshots and this explanation was in Appendix A to my reply report. Okay. So the issue is a little bit the following. So for 1974, row 57 there, you see it shows the Excel formula. And I apologize for having to explain formulas, but this cell will be the sum of rows 52, 53, and 54 minus the sum of 55 and 56. So what does that mean? It means you take 52 plus 53 plus 54, add them up. There's 2 zeros and 37 million, so we're going to get 37 million. And then we subtract the two zeros. Okay. 37 million subtract 0 is 37 million. Now this is the row, we talked about a little bit earlier. You'll see the label is Natural Resource Management Capital, NES, not elsewhere specified. So this is one of those other rows, if you will. But the issue here is that the original entry and the other row are both included. You see they're fully filled in on the left-hand side. Like row 54 is MNR, Forest Management, Woods 1. Row 57, MNR, Forest Management, Wood 0. So the computer code is going to read both of those in. The computer is very diligent, but it doesn't know that the same number appears twice. I mean, it could test if you asked it to, but it doesn't understand that this is a remainder row, if you will. And what do I mean by that? If we go to the next slide.
But before we leave there, you need to explain for me and maybe others. Line 54 has a exclusion code 1, whereas line 57 has an exclusion code 0. Don't they just cancel each other out?
No. So exclusion doesn't actually mean throw it away. It means when we come to that adding up exercise, we have our 3 pots, right? Fully relevant, partially relevant, not relevant. You're going to put 37 million in both the fully relevant pot and the not relevant pot. So the total will end up being 74 million, even though there was only one expense for 37 million. Does that make sense?
So which one is the duplicate then? Which ones are the duplicates? Is it line 54?
54 and 57. And I apologize, 57 shows the formula, but if we go to the
You'll
next
see it on the
page,
next
you'll see you
screen,
get the same
slide
number.
249.
So slide 249 is how this looks once you evaluate that formula. And you'll see the same number, 37,335,044 shows up twice. And we know why, because on the prior slide, row 57 was the sum of 54 minus 55 and 56, and you get this remainder row. So it's the same 37 million, it just now shows up twice in the data. And on slide 249, we can check in the public accounts. There was one entry for $37,335,044, and it's tagged as outdoor recreation. Now, what Professor Bodwan Smart now agree with me with is row 57 should have been exclude equals 1. So when you finally come to adding up the expenses, it shouldn't be counted as relevant because it's related to outdoor recreation. But it seems they don't agree that the number 37,335,044 appears twice, or that it's counted twice. Now, if I can go through one more example.
Yeah, you're gonna have to explain how they counted it twice.
Sure. So the computer, the data file reads, I guess we should stay on 249 then. The data file will read each line item as kind of a separate database entry. And it's going to read line 54. And remember, given actually, maybe we should go back to 248 where we have all the columns, I'm trying to say. It's going to read line 54 and say, I have something MNR related to forest management, related to wood, exclude 1, $37 million. It keeps reading. Then it's going to read line 57 and say, Ministry of Natural Resources, Forest Management, wood, exclude 0, $37,335,044. So when we look at a snapshot of their data code, we then see the number here twice. Okay. Is that okay?
Well, that explains how it appears twice in the document, but it doesn't explain, I don't think, how it's counted twice or where there's what the duplication means for the result.
Right. So what the duplication means for the result here is that your total is going to be $37 million higher, because the $37 million only appeared once in the public accounts. That's what we looked at on slide 249. But when the computer reads all the data, it gets 2 entries for 37 million. So when you sum up all those expenses, we can go back if we want to slide 245. The green line is $37 million higher than the blue line in 1973. Hard to see, but 200 million.
Yes.
That one says. So that's the impact.
Okay, so but did they use the blue line or the green line to allocate expenses?
Green line.
Okay,
That's the
that's
issue.
the shoe dropping.
Yeah.
Okay. So is the slide of 250 an example that helps us?
Yeah. So 250 is another example, and this one I think helps us with thinking about why there was this weird Excel formula to add things up and subtract things. Because the first example just made it look like the same number appeared twice. What happens here? So the formula is here for 2019. And you see again, it's the same formula. Add up the first 3 rows, subtract the last 2 rows. Okay. That $37,988,069 appears once in the public accounts. I've circled it down below in red. But the impact, and maybe we can look at 2018 because all the numbers are there. So in 2018, it was $48 million. They're then saying 4 million of that, or 4,822,000, was a transfer to conservation authorities. 12,193,000 relates to Ontario Parks Capital. All the rest is 31,800,000. That's the natural resource management capital, not elsewhere specified. So I think the way to read this, at least how I would read it, is there's the total. You then subtract out the 2 things you know are excluded. You'll see transfers to conservation authorities and Ontario Parks Capital are both 1 because conservation authorities and Ontario Parks Capital are not relevant. And then everything else is other capital expenses related to natural resource management, and that's relevant. Okay. Those 3 rows are kind of fine. The problem is the first row, row 52 there, is included because the exclusion code is 0, and it's $48 million, 815,000. So effectively what's happening is there was one expense for 48,815,000. When it gets read into their computer program, they're going to say there was actually $97 million of expenses. And of that 48 million, there's going to be about 17 million, the 4,822,000 plus the 12,193,000. That's not relevant, goes in that not relevant bucket. And then there's going to be about 80 million that is relevant. The first row, 48 million, and the last row, 31,800,000. So again, 2 issues here. The total has gone up. That green line is above the blue line. And rather than having 31.8 million in included relevant expenses, there's going to be a little over 80 million in included relevant expenses.
So you've just taken us through the calculation for 2018, but the slide actually takes us through the calculation for 2019.
That's right. It just, you can't see the total behind that sum. So I went through the one next door. But actually, if we can go back, so this slide, I'm not going to go out of order a little bit. If we go back to slide 240 for just a second. I want to highlight, where I think the issue is mechanically how we corrected it. So slide 240 is this zoomed out view of all their expenses. And I want to draw your attention to the first 2 lines that are highlighted yellow. See, there's natural resource management in bold. And then maybe 10 lines down, there's natural resource management NES in italics.
Yes.
So I think we've talked about this a little bit earlier, but natural resource management, not elsewhere specified, is that bold row minus the constituent elements. Right. So this is the leftover row, the remainder row. And if you look at how the first total row is coded, it's not only excluded, but the category is blank. Okay. It's M&R and there's no category.
No category, yes, second line.
Exactly. So that
Yeah.
means for this set of expenses, which are the ordinary expenses, for natural resource management. The computer's not going to include the total row. So you don't have the same double counting problem. It's going to count all the constituent sub rows underneath, but then it's not going to count the 390 million. The issue, if we look at the orange rows that are highlighted, is that there is a category for the total row. So those orange rows are what we've been looking at. You see, it is forest management. So if the orange row was treated like the yellow row, there wouldn't be this double counting issue.
Sorry, the category is the sort of the subtitles that fall under it.
Yes, so forest management, land and water, survey, those kind of labels we assign.
Right.
And if it's blank, which is it is for natural resource management, then it will eventually get dropped by their computer files.
Oh, it's blank in value 2012.
Oh, no, sorry, what I'm talking about is it's
I'm
the
on
category, the first yellow row that's highlighted,
Yes,
there's no category.
So the second column
got it.
is the
That's where it's
category
Yep,
column.
I get it. Thank you.
Exactly. But if you look at the orange rows, it's both the total and the remainder row are both forest management. So they both end up counting. Does that make sense?
Yes, thanks.
So I don't show all the code here, but if you were to just delete that forest management entry that's bold in the orange row, you get back the chart I showed where the totals match again. That's where the double counting stems from. Thank you. Okay. There's one more double counting issue. Let it be a little more parsimonious. So I pointed out in my reply report that because colonization road spending is included under the Department of Lands and Forest spending for purposes of allocating overhead, the result is that more than 100% of the overhead of that department is attributed to net crown resource revenues. Put differently, the expenses are more than the totals again. So I call this another double counting issue. In their SIR reply, Professors Beaudoin and Smart write, Mr. Hutchings is confused by the history of the colonization roads branch, which migrated from the Department of Lands and Forests, DLF, to a separate Department of Northern Development in 1926, but continued to report to the Minister of Lands and Forests. Since it shared head office functions with the DLF, we've allocated a portion of its budget as overhead costs of the DLF. Since we do not account for the overhead costs of the colonization roads branch elsewhere, that is appropriate. Whether or not the colonization roads branch reported to DLF, the data problem of how they've moved over the roads branch is they've increased the included, but not increased the total. And so we end up with overhead allocation percentages over 100%. So there's not a portion of the budget allocated as overhead costs. There's actually more than the total spending allocated as overhead costs.
And are you?
Sorry, I missed something. They've increased the what, but
They've
not,
increased the included expenses. So if we think about our three factories,
yes,
they've made the included factory larger, but they didn't reduce any of the other factories and the denominator stays the same. So as a result, there's more than 100% of the expenses considered included. And the amount of overhead that gets allocated to our included factory is over 100%. So in the example we'll go through, there were reported head office costs of about 98,000 and about 112,000 get allocated. So rather than allocating a portion, they allocate more than was actually spent. Okay. So back to this screenshot of their input data.
Slide 253,
Slide
yes.
253, yes,
Yes.
thank you. The three rows at the top are in a red box. Those are the overhead items. Salaries and contingencies, insurance, the usual overhead items we've seen. And we know they're overhead because in their exclusion column, it's 2, and 2 is their code for overhead. The issue is they've included here the colonization roads branch, $508,000 in 1927. They've assigned it to the DLF ministry. Per their explanation on the prior slide, that's because colonization roads reported to DLF. And so some of that overhead should be allocated to the colonization roads branch. Now, the issue is, and we'll see this if we go to the next slide, 254, I've circled another number. Down at the bottom there, you see the second to last entry is total DLF total expenses, 2,527,146. I'm on slide 254.
Got it.
This is the number right above the red box. So that's the total expense of the Department of Land and Forest. But when they moved over that $508,000 for colonization roads, they didn't increase the total. And so the result becomes, we again have one of these unitemized or remainder rows. That's the last line there. See, unitemized and excluded DLF is a negative $508,000. So they're saying, you know, that other category is negative $508,000.
So additional expenses.
Yes, exactly. So they're saying by having the other row be negative, they're saying they excluded a negative amount of expenses. So when we do our factory allocation, the irrelevant gets a negative apportionment and the relevant gets more than 100% apportionment. And this stems from, you know, this negative 508,000 is the total minus all the sub items, right? But they've added a sub item, colonization roads, and they haven't updated the total. So the result is it's negative $508,000.
And this screenshot is
Right.
from whose report?
2534,
254.
that's their work paper again.
Okay, so their work paper actually shows negative 500.
That's correct.
And then over on the next page?
Yeah, so we'll go to the next page, 255, and I'll try to explain this plumbing diagram. On the left-hand side, we have a snapshot of the Stata code, or the Stata, not the code, the data as it's loaded into Stata. And you'll see there, the first column is the year, the second column is the ministry, we're just looking at DLF. The next columns are min EXCL, which means ministry excluded. Then min INCL, ministry included. And then finally, share INCL, share included. I want to draw your attention to the red box, which are the years at issue here, where the ministry excluded expenses are negative each year.
But before you go on,
Yeah.
this little screenshot of 1923 to 1940, where did that come from?
That came from their work papers, the file provexpense.dta.
This is their, so you will find all of these numbers in their work papers.
That's correct.
Sorry, you were telling me about the negative numbers.
Right, so the red box is the negative numbers. And the implication of that is that the green box, which is the share included, or how they calculate their overhead share, is over 100%. Now, why is that? Well, let's look at the code on the right-hand side there. We've circled in green. It says gen share INCL. What does that mean? It means generate a new variable named share INCL. So this is where you do the math. Equals min included divided by min included plus excluded times 100. But because min excluded is negative, min included plus min excluded will be a smaller number than min included. And that's why that ratio is over 100 in each of these years.
And to go back to Mr. Schachter's question on an earlier item, when he said, how did you catch this? Is this an obvious catchable if you have attributing more than 100% of expenses?
Yeah, so this one, we wanted to look at the difference of how much overhead we allocated because we described it in similar words, but weren't getting similar results. And then when we looked into it, we saw the numbers were generally higher, and then there were some over 100%.
I take it you don't think that's right.
No, that's correct.
So is there one more slide or?
Yeah, so 256 is kind of what happens. So the prior slide, you take that share included, and then you replace the value of the overhead expense with the value multiplied by that share. So this is where you attribute it. So on slide 256, I kind of show the result. This is 1927, which is that year we looked at earlier. Recall the input data for salaries and contingencies. This is in the bottom right, that red box. Was $98,956.25. This is from the public accounts. However, when it comes to doing their NCRR calculations, the value on the left is what's used, which is after they've done the allocation. That's in red. 1927, salaries and contingencies, $118,258. And this isn't the amount that then has to be attributed. This is the full amount that's charged against the net current resource revenues. So in other years, like if we were to look at 1921, see that value there, share included 91.5, the first one. That 147 would be strictly less than the number that includes in the public accounts, right? Because this is where this is their factories, right? They've said, oh, here's the amount, here it is. But we know now the head office of the factory, or the head office rather, it's $99,000 roughly, $98,956. But then of that, they charge the relevant factory $118,258. So, yeah, just, they're charging expenses that weren't incurred. And again, it all stems from, just to go back, moving over the colonization roads branch, but not increasing the total, doesn't increase the overhead allocated to account for the fact that some of that $98,000 funded the colonization roads. It just leads to this weird thing where, over 100% are allocated, which can't be right.
So it's arising from moving the colonization roads branch from DLF to
From Northern Development to
DLF.
DLF. Their statement is that it still reports to DLF, and that's fine. But if you're going to increase the sub items, you have to increase the total. Does that make sense?
Yep.
Okay.
We're very close to 4 o'clock. It's been a long day.
You want to do there's only one last SIR reply issue.
Did you want to go through
It's
it?
your plane.
You, okay?
Sure.
Let's deal with it.
Sorry.
I'm putting it on you. It's your plane.
Okay. Need a little excitement, a little adrenaline rush. It's really nice. So the timing of forestry expenses.
I thought that was the whole day.
It's a lot of excitement.
Zing.
Okay, so I talked earlier about, I think very near the beginning, about reforestation expenses and why I exclude them. And Professors Bodway and Smart in their SIR reply raised this criticism in paragraph 21. Mr. Hutchins also fails to see that forest regeneration expenses are properly offset against the value of timber that was extracted in the past.
We're on slide 258.
258. Yes.
Thank you.
Therefore, regeneration expenses of later years should be compared to forestry production or GDP data of earlier years. Now, I discussed earlier in the years where reforestation data, expense data are available, we know the reforestation zones were all in Southern Ontario. And that was part of the reason why I excluded them. And there is some support for that. This is a quote here below on the report of the Ontario Royal Commission on Forestry, 1947, says the following.
And before you go, this, I understand, is a document in the agreed document set.
Yes, I believe.
Yeah.
I know Professors Bodway and Smart cited it. Maybe I did. I've certainly read it before and we've seen it a bunch. So it says it is unlikely that any major rehabilitation project of this nature can be financed out of revenue. The cost of the proposed plan should be considered an expenditure to replace depleted capital assets and the financing done out of capital raised for this purpose. Here's the main sentence of the proposed expenditures for the reforestation of Southern Ontario would therefore be financially unrelated to the revenues from Crown lands situated elsewhere in the province. So this is, confirmatory of what I talked about earlier, that here's the Forestry Commission itself saying the expenses in Southern Ontario aren't related to the revenues now being generated in Northern Ontario. So at least until 1947, the reforestation expenses aren't related to revenues.
So you weren't making a qualitative distinction, you were making it your categorization of whether it was relevant or not was based on where it was in the province.
Yeah.
Not whether it was reforestation or as
Oh,
a
yeah.
concept that applied.
Well, I think there's another reason that reforestation generally like now tends to be undertaken by private companies, and that would be reported and maybe calculated in rents. But the more specific claim, you're right, is a geographic one, that in the period where the data are separately reported, it doesn't occur in this area. Yeah. I'd also just note in the comment they raise, comparing regeneration expenses to production or GDP, I don't think is an exercise that either one of us has undertaken. Tended to look at it only in relation to resource revenues. And this, I think, again, speaks to the potential imbalance between the benefits being calculated and the costs. So, I did look at forestry GDP data earlier. That's how I adjusted and allocated some of the forestry expenses between the direct and indirect. Okay, I guess my last, perhaps ending the disagreements, where we began with what is the main disagreement, is on forestry expenses. And this is, the same sort of smell test chart Professor Stiglitz had last week. This is slide 259. And I've done the same sort of thought experiment of if after 2019 costs or expenses were flat in real terms, despite having gone up a lot since 1960.
When you
And-
say gone up a lot, according to Bodway and Smart.
Correct. All of this is based on Professor Bodway and Smart's data. And revenues were to grow at 5% per year compounded. So this is one of those constant rates of growth that lead to the curvy picture I was talking about earlier. Then we see the break-even point is in 2067. And I want to clarify, the break-even point isn't the point at which value, as we might think about it, becomes net zero. It's where you stop digging the hole of losses. Right? Every year under this assumption, up until 2067, the losses would be growing. And so the cumulative loss through 2067 would continue to grow. And it would take about another 100 years before gains. And if that same rate of growth continued with no increase in expenses, it would take about another 100 years before you would cover that gap. So this just returns to between the two hypotheses of, are these investments for the future or regeneration of the past? If that's true, you have to believe revenue growth like this is possible for 150 years. Or stronger revenue growth for a shorter period of time, but something we've not observed. Or we have the alternative hypothesis that the expenses should be allocated amongst some of the different benefits that Crown's receiving, which would reduce the expense line. And that leads us back to the conversation we were having about GDP. Is that? Okay.
Well, we are at 1 minute past 4, and thank you. I think that's it for the day. I have a little bit left over. Perhaps after the witness leaves today, we can stay and talk about when we start on next Tuesday.
Tuesday. All right. Are there many people leaving at this 4 o'clock or do we have 5 minutes?
I think we have 5 minutes.
Okay, I just want to say, thank you, sir, for this week. You are excused from the stand. We're going to do some housekeeping. And we can
Yes.
be off the record. Yeah.
Oh yay, oh yay, oh yay. The sittings of this quarter now concluded. Thank you. Long live the king.